Hello and welcome in this channel. In this video, we are going to talk of supply and demand. What is supply? So this is an area where institutional selling pressure is expected. While we talk of demand, where buying pressure is expected. So that is the simple definition that I can give when it comes to supply zone and demand zone. So let's have a look at what we usually expect when we have supply and demand. Let me use a simple skeleton to show this. When a market creates demand at that point, we expect the market to come back this point, then we can buy from the same zone again. So that is what we mean when we say that you have a demand zone. So what you usually see in the market, you're going to see the market start to retrace this zone and the market will continue buying from the same zone again. When we have supply, this is where the selling pressure starts. So you have your supply zone at this point, and you expect the market to retrace back to this supply zone. Then you can continue selling from the same zone. So you expect to see the market start to retrace to the same zone and continue selling from that point. So this is what we mean by supply zone and demand zones. But these ones, you're going to find that this is the simplest model. If we start advancing when it comes to supply and demand, then you're going to talk of inducement and also liquidity, whereby you find that the market does not just move that in that simple manner, whereby the market will come so this is whereby things starts to advance, whereby you find that the market, it creates some sort of liquidity here called the sell side liquidity when you have a demand zone. So you have this as your so this is your sell side liquidity. at that point. Now, when you talk of this area here, this is an inducement zone, whereby, and in most cases, when you have such a model, you find that the market will always retrace back to the fair value gap, or what we call inefficiency. When the market comes to feel that inefficiency left in the market, then early buyers will start getting into the market. Then this will serve as an inducement zone here and create liquidity below this level. Then the market will drop again and take liquidity and continue moving in the same direction. So at this point, this is where you hear traders saying that the market liquidated me. That is because they were not patient enough to wait for the market to come to the demand zone where they can take their buy positions, then the market moves with them. So that is one. The same way it applies to when you have a supply zone. So this is what you find. When you have a supply zone, the market will create the buy side liquidity. So at this point, you have your supply zone at this point. Then the market will create liquidity above this level, whereby this area here, you find that the market will have a zone of inducement. So this fair value gap that is below here, in most cases, you find that it is a fair value gap. Then the market will, early sellers will enter the market from the fair value gap, expecting the market to move lower. Then the market comes back, takes out their money, which is placed at this point. So every order that has been placed above this point is liquidated. Then the market gets to the real zone and sells from that point. So that is how liquidity and inducement works when you have supply and demand. So at this point, this type of liquidity, we call it the buy side liquidity. So let's go to the real charts, and now we can start explaining whatever we can see. So we have our charts here. If you look at the charts, you're going to see that the market at this point, we're also going to include the OT zone when it comes to marking the break of structures. So have a look at this. We have this buying pressure here. Then the market sells and continues to buy upwards. So if we start analyzing the market, you can see that below here, the market creates this demand at that point. So you have that demand zone. Then you can see that above here also we had another demand zone at this point. And the market came back to this demand zone. So this demand zone here serves as an inducement zone. So this is an inducement zone whereby the early buyers will place their orders at this point. So the early buyers will place their orders at that point, set their stop losses below there, expect the market to move perhaps up to that point. Then the market retraces when they are almost close to the take profit. The market comes, takes their orders, and comes to this demand, then continues moving upwards. Now, one thing, if the market has already taken out liquidity, sometimes the market cannot, it doesn't get to the zone that you expected the market to come up to. Then another thing, if the market feels liquidity, the inefficiency in the market. So at this point here, you can see that the market feels that inefficiency, that the fair value gap that we have. Then the market cleared liquidity below this level here. So we have liquidity below that zone, and the market has already taken out liquidity. Again, if you look at this, the market had also induced other traders to enter in the market at that point. Now, if you missed on this one, then there are others who took a trade at this place here, thinking that it is a confirmation. But we have a zone here, and we have liquidity lying below this zone. So the market comes, takes out the liquidity below this level and also this level here, because we have a demand at this point. We see buyers get into the market at that point. And when it comes to demand, one thing that we look at is the origin of a move. And this is the origin of this impulsive move. So it creates this demand. It's fresh. It has not been mitigated. Then we have imbalance above it. So that is what makes a demand zone credible. So we have that. Then the market continues to push upwards. Another thing, you can have a look at the market from different time frames. For example, if I go to the 4-hour time frame, you might find that the market has already mitigated that zone. So this is the 4-hour time frame. On the 4-hour time frame, this is the same demand that we see on the lower time frame. So you can see even on the 4-hour time frame, you have a clear picture in the market. So you can also use the OTE zone, use your Fibonacci retracement tool, and you can see that the market retraced to the OTE zone. So the OTE zone is usually located between 0.618 and 0.786 level at that point. Then the market continues to move upwards. So we have that. So that is a type of a demand. Then if you continue to analyze this chart here, you're going to find that the market again retraces back to this point here. Now, if I see this kind of rejection, it tells me something when I go to a lower time frame. So we are going to mark that zone, and we are going to concentrate on it on a lower time frame. Then again, on the top here, the market has a supply zone. So this is where we have the origin of this selling pressure. We have the selling pressure at this point, and actually you can see that we have a very tiny fair value gap or imbalance above here. So the market retraces back to this point on the 4-hour. You can see that we have that supply zone at that point. The market continues to move lower. We are going to have a look at the market on another time frame, that is the 1 hour, and see what we have at this point. Then the market continues to move downwards. We have another supply at this point, whereby this is now the origin of this selling pressure from this point. The market retraces back and taps on that supply, continue moving downwards. Again, the market on the 4-hour, you can see that this candlestick here, we can see the rejection. So it creates another origin of this impulsive move here. Again, the market retraces back to the supply, feels the imbalance in the market, and continues moving lower from that point. So let's have a look at the market from the 1-hour time frame and see what do we have on the 1 hour. Now, these are the zones that we have. If you look on the 1-hour time frame, if we zoom, you're going to notice that we have this, the last candlestick, the last bullish candlestick that is at the top there. That is the candlestick that gives us the supply zone. So we mark it as our supply. So the market retraced back to this point and continued moving lower. So we have that. Again, the market creates this demand, this supply zone. The market retraces back to that zone, continues moving downwards. If you have a look at this one here, you're going to notice on the 4-hour time frame, you have that as a bigger candlestick, because every candlestick here is 4 hours. But when you come into the 1 hour, you're going to notice that above here, we do not have that inefficiency. So inefficiency starts at this point. So the market retraces back to that zone. Again, you can use your OTE zone to find an entry in the market. Let's do that. So we have our Fibonacci retracement tool. You just mark from the beginning of the trend to the end. The market retraces back to the OTE zone here. So you can mark this as your OTE zone. So you can also use the OTE zone to find entries in the market when it comes to supply and demand. Then take out your Fibonacci retracement tool and set your buy position or sell position at the 50% level of that. Perhaps your target being this point here, that is your take profit, and your stop loss slightly above that point. So you can see another example. If we pull our Fibonacci retracement tool from this point here all the way down to that point, again, the market retraces back to the OTE zone. So we can mark our OTE zone, which aligns with our 4-hour supply zone. So we have that. And you can see, so at that point, you can have your entries. That is how you secure good entries in the market. Okay, I hope that is clear. Let's move to another chart whereby you're going to see more other examples. Let's have a look at the market on Euro JPY. So on Euro JPY, you're going to see that we are going to start analyzing from this point here. You have this uptrend. On this uptrend, you can see the first thing that I'm able to locate below here, we have this buying pressure. So where is the beginning of the buying pressure? We have that level there. Now, when it comes to marking the supply zones and the demand zones, there are certain things that you can single out, which are common when it comes to supply zones and demand zones. One, you're going to notice that demand are always formed at the beginning of the impulsive move. That is the origin. Then the second thing, when it comes to supply and demand, you always have inefficiency in the market or imbalance or the fair value gap. That is what we are looking at. So we have that. Then the market retraces back to the demand, continues moving up. If you start using market structure, you can mark that break of structure at that point. So you have that break of structure. And you can see also we had another break of structure. If you start analyzing from this point, the market continues moving up. Then at this point, the market retraces back and we have this zone here. Now, if you look at this area here creates this is an inducement zone. Reason being, let's move to the 30 minutes time frame. So you need to have a look at the market from different time frames so that you can have a clear picture of what is happening in the market. And that is where most traders miss out on. So on the 30 minutes, you're going to notice that we have this area here. So we have that candlestick, which gives us this. This is an inducement zone. So if you have a better zone below and you have another zone, always take your trades from the farthest zone. So this is our farthest zone, which we have in the market. This is our extreme point of interest. So we are going to mark this as our extreme point of interest. So that candlestick gives us, this is where the buying pressure actually started. Then the market creates an inducement zone. So we have liquidity lying below this inducement zone. So this is the sell side liquidity lying below here. So the market takes out liquidity below this level, then continues moving upwards from that level. And actually, you can also see that from this move here, the market retraced and filled that zone. So we do not have any kind of inefficiency at the market at this point. So this is where we have that fair value gap, straight in fair value gap or inefficiency above here. We have liquidity below this level, and this area was our inducement zone. So if you are intending to take your buy position from this point, then the market gets to liquidate you, then continues with your direction. So that is why you hear traders saying that I got liquidated. It's because that they were not patient enough to wait for the market to get to their real zone. So you need to be patient when it comes to forex trading. Then again, we have this buying pressure from that point on the 1 hour. So if I single out, you're going to notice we have another demand at that point. And we have this inefficiency, slight inefficiency above here. So the market will always retrace back. And if you zoom into a lower time frame, you're going to notice that we have, you're going to notice that it's even a bigger gap in between here. So the model that I usually use to analyze the market is called the top-down analysis model, whereby I analyze the market from a higher time frame, like the daily time frame coming to the 4 hour, 1 hour, then I take my entries at the 15 minutes time frame. Again, at this point now here, we have an order block. An order block, you mark the decision candlestick that led to the buying pressure. And order blocks are they signify institutional traders getting into the market. That is the banks and the hedge funds and also the big investors. So order blocks are very rare to form in the market, and they are a special type of supply and demand. So when it comes to marking the supply zones, the order block, we see that they are the most functional type of supply and demand. So we have that the market retraces back to the demand, continues moving upwards. So at this point here, you can be able to see that we have the market. When it comes to demand zones, either the market will create liquidity below the levels, the reason being that we had an inducement zone. Or else, you're going to have such direct, whereby the market will retrace to the demand zone immediately, then continue moving upwards.